Good afternoon, everyone. Can everyone hear me?
Yes.
Okay, great. We'll be starting the meeting in about 3 minutes. Please leave us a chat message if you have any trouble hearing or seeing the meeting. All right, we're back. I have Tom Miller joining me from Radian Mortgage Insurance. He's going to be conducting this training for us. I'll leave it open to him now. Thank you for attending.
I appreciate it. Well, good afternoon, everybody. Like Leslie said, I'm with Radian, and my name is Tom Miller. I'm the Senior Account Manager. I cover Waco, Austin, and San Antonio markets, so all about Central Texas. And just excited to be able to get an opportunity to help educate everyone on becoming an MI expert. I don't know if a lot of you know, but one of the latest surveys that the National Association of Realtors did, especially amongst millennials, were that 83% of millennials thought they needed to at least put down more than 10%, which is kind of crazy considering millennials typically are using the internet more and can find out more information. But that's the misperception among millennials. I'm sure it's high amongst the general population as well, that they don't know that they can put less than 10% down. But they can, and we're one of the people that want to help them do that. And I know you guys are as well, especially with your new 1% program that you guys rolled out, and just with the regular 3% program, Home Ready and Home Possible, that Fannie and Freddie have both introduced as well. So it's really time to use these products to educate your markets, your realtors, your borrowers, your areas of your sphere of influence, that you can help these people know and help change that perception. Because there's a lot of good borrowers out there that, like we said, just still think that you have to put a lot of money down. So one of the ways of doing that is, if you're already an expert maybe on the FHA side, is become an MI expert. And that's what I'm going to help cover to teach you guys today. Go over a bunch of things so you'll know everything you need to know about MI. So I'm going to go over a couple different things. I'm going to talk not so much about the FHA pricing changes. This is actually a little bit older PowerPoint presentation that I have here, but going to talk about MI becoming a bigger factor in the marketplace, talk about some typical borrowers, QM compliance, housing values, and also talk about some things about the different MI programs that are available, and also a way that you can save your borrowers thousands of dollars in mortgage insurance if you didn't know how to do it before. So we're going to get started. Just first off, went too many slides. Typically in the beginning of the year, the origination market thought it was going to be down, but it's actually not been that bad so far this year. But this is just a graph of what they are expecting throughout the year. And I'm sure you guys are seeing that it's really not as bad as people may have expected. They expected like a 21% decrease, and I don't think the market's seeing that right now. So, but these are numbers, though, that show the share of FHA and MI in the origination market quarter over quarter. And if you see, FHA was on the down most recently in over last year, and MIs have made a comeback. So far this year, MIs have actually been on an upward trend, especially because of Home Ready and Home Possible programs. And now with the new 1% that's going to be out there, I expect this blue line to really be going up and red to be trending down with these products. And that's really the purpose of them. That's why Fannie and Freddie have rolled them out, to get more market share from FHA. So if you thought FHA, if there was a bigger market for FHA than MI, you'd be wrong, and it's a good reason to be learning more about that. Here's the actual share of the purchase market as well, quarter over quarter. So you can see, still looking good, and I expect both these lines to be separating even more. This is FHA's pricing. It stayed, it did change there for a little bit with the new administration, though. They changed it back to what's been traditional for years. So if you have a 95% or greater, it's 0.85 for the monthly renewal. If it's 95 or equal or less, it's 0.8. That's going to be good for some of the factors I'm going to show you guys in some of the calculations later on, but just a reminder on that. So why do you want to market yourself as the MI expert? They have a couple different reasons, but borrowers do want options, and I know you guys try and sell a lot of options to them. But again, like I mentioned earlier, a lot of the borrowers don't know about mortgage insurance, and things like how do you cancel MI? That's my most often asked questions, and we're going to go over that today, and also just how to price and give you a number of different options that you may not know about. A lot of people think that only high FICO score borrowers can go conventional. That's not always the case. And actually, Split Edge is going to be a product I'm going to tell you guys about that you can use for your FHA borrowers. That's going to help them out. And also, one of the factors that you need to do with this is knowing your customer. I'm going to be giving you so many different quivers or arrows for your quiver to be able to help you deliver that loan. That I'm not going to say any one is particularly the best. It's just going to be a matter of finding one that fits for your borrower in the best in whatever situation that they find themselves in. But if you're able to do this and you have all these quality products, and it's going to help you differentiate yourself, the more likely you are to be able to close the loan. One other thing about millennials that I've heard recently is a lot of them, like 31% of them recently, due to a survey on Redfin, they've bought homes sight unseen. So they haven't even gone to visually see it besides what they've seen online. So as that market becomes bigger, they're also going to be doing that for mortgages. So how are you going to stand out? What kind of value are you going to be providing to help those borrowers in the future know that you're the one that they want to deal with? Because a lot of them, 83%, don't even know that they don't have to put more, or they think they have to put more than 10% down. So let's go over that. So Radian has one underwrite guidelines. We make it really easy to get loans approved with us. If you have an LP or DU approval, an approved eligible finding, technically we almost have no overlays because these are really just Fannie and Freddie guidelines, but you at least have to have a 620 FICO score. If you have a 97% loan to value and below, investment properties are eligible up to 85%. 3 to 4 unit properties are not eligible with Radian, but we have no additional overlays to what you have approved in DU or LP. So no overlays for DTI, none for reserves, none for condos, none for gifts. Even for your 1% down program, we have no overlays on that. Actually, if you do a 97% loan and use like a TSHAC or some down payment assistance programs that are provided by housing finance authorities, that'll use like your local government maybe doing them, that we go up to 105% total loan to value and still treat it as a 97% loan to value. So our average turn time I don't have June's data yet, but for May, 77% of all our loans were turned around in less than 2 hours. So hopefully you don't need it faster than that, but if you do, you can always, your processors here always know to ask me for a rush if they need it. I'm here to help out with that. But there's several different MI products here. Going to go over just kind of some of the this is a quick hit look at it. But from left to right at the top, the products are borrower paid monthlies, borrower paid single premiums, borrower paid split edge, which I'm going to get back to and spend a little bit of time on, and lender paid MI singles. So there's a difference between borrower paid singles and lender paid singles, but we'll go over that a little bit. So the premium structure for borrower paid is regular monthly MI payments. That's probably about 85% of what I get from a business standpoint. That's just the standard. If you're competing against other people, that's most likely what they're quoting your borrower. That's probably what your borrower is going to find out when they look up MI and quotes on MI. It's this. Borrower paid singles is what's next. Maybe somewhat common, actually, but it's really dying off fast. Less than 6% of all my business comes under this. Big reason why is because it's now included in the QM cap for 3 points and fees, or the 3 percentage points for points and fees cap. It's included in there. So a lot of times that premium can be 1 to 1.5 to 2. That can eat up a lot of your room for QM of other fees that your borrower has to pay. So that usually discounts this category. So that's why we don't see it too often. Split edge is typically used for help borrowers to get a lower DTI, especially if you're really tight on that 45 or maybe 44.9 and actually, let me say you're at 45.01 and you need to bring it down just a little bit. Split edge can be used for that, but there's also some really cool pockets of areas to where you can save your borrower a lot of money, particularly on the lower FICO scores I'm going to tell you guys about. That's where you can save your borrowers, can be possibly thousands a year. And then lender paid MI singles. This is the cheapest way to get MI, and this is our cheapest cost for your borrower, especially you just look at it in one lump sum, but it does counteract because typically you raise the rate to pay for this, but the lender, Security National for you guys, would be paying this after closing. So the other downside, or one downside to it, is it can't be canceled. So you do bump up the rate a little bit, but you can't cancel it, but it is the cheapest, and you also get a tax deduction. So typically these are your high FICO score borrowers. They have income exceeding $100,000, and you're in this 85 to 97% loan to value range, but it's definitely for high FICO. And by high FICO, I mean 720, 740 and up, really for here. I said before, it's not refundable. You can pick refundable option for any of these products, but usually in the marketplace, everyone's usually quoting non-refundable because that's the most aggressive pricing. I don't see refundable options being quoted under any three of these options, so I wouldn't recommend doing it. You can do that on our website, and through Encompass, you may even be able to click it, but refundable for monthly usually never makes sense. Maybe refundable here, but if you were to quote one, it wouldn't put you in a competitive situation against most other people that are quoting them. So I wouldn't recommend it there. Lender paid MI is never refundable because you're paying it all up front and it's part of your rate. You could do it here, but again, the pricing wouldn't be as aggressive. And all three of these are cancelable, and we're going to go over cancellation, how that works later. Lender paid singles can't be canceled. And kind of these go over different sweet spots. The reason why borrower paid is it's the cheapest usually for lower income earners if they're earning under $100,000 and have a high loan balance. Singles, if they're over 740, are very similar to lender paid. So I can get this out to everybody later. We can send this out for you guys to reference this later. But I just want to make sure these are the differences between the four, the major differences. But all of them go down to 620, and all of them are all eligible for Radian's one underwrite. So underwriting less than 2 hours. So how does QM affect mortgage insurance? QM can be an issue for you, like I said before, on the borrower-paid single premiums. So if you're trying to have your borrower pay for all their MI in one lump sum, which used to be popular prior to 2013, it was more popular, especially this October 17th date. It was more popular, but as soon as QM came out as a result of the CFPB's update, it really died off. We probably had 40 to 50% of our business came from that channel. But like I said, it's now down to less than 6% for me, just because it creates an issue to where it has to be included in that 3%. Even if you're paying for it, which one way of paying for it under borrower paid singles is for you to raise the rate, and this is how it was traditionally done. The loan officer would raise the rate, get a lender credit, pay for the MI up front on the HUD, but you don't call it HUD anymore, CD, on the CD, and it would all be shown that way. But because of that, it has to be included in the QM calculations. If you do a lender-paid MI, which I showed you guys earlier, lender-paid MI singles, it doesn't have to be shown up on the HUD. The reason why it's not is because Security National is paying Radian that money after closing. It's outside of closing, so it's not included in the QM. So hopefully it helps you guys understand that a little bit better. And just to reinforce that, we got another slide here that shows what's included in the cap, what isn't included in the cap. Borrower-paid singles are included in the cap. Borrower-paid monthly, which again I said is over 80% of the business, is excluded from the cap. Lender-paid monthlies, which you guys don't do, only some credit unions do this. Don't worry about that one. Lender-paid singles, again, because it's not included on the CD and it's outside of closing, it's excluded from the cap. And split edge, the monthly renewal portion of it's included, is excluded from the cap, but the upfront portion is included in the cap. So it's kind of on both sides of the fence, but we'll get to that one later. So first off, just to dive a little bit deeper into each of these again. Borrower paid monthly, most widely accepted, the broadest guidelines, just the easiest to use across the board. You really don't even have to think about it. You quote the rate by the corresponding FICO score for your borrower and the loan to value. We highlight in yellow what the Fannie Mae's recommended coverages are, and this is for the typical programs. So like for your 1% down program and the 3% down program, which Radian is your exclusive provider for, and we're grateful to do that for you on mortgage insurance, 25% is the coverage for 90 to 95, and for 95 to 97 is what you guys would typically use for those products. So hopefully you're doing a lot of those and seeing a lot of those. That's my fastest growing area of business that I see out there is Home Possible and Home Ready. So I'm not going to get into too much further on the other items here, but that's the biggest things I want to hit for you on those. This is just a cost example on a $250,000 loan amount. This is an FHA loan at 95%. We're not even going to 97, just if they wanted to put 5% down, because it's cheaper MI, that 0.8. A regular borrower paid monthly if they had a 740 FICO score in 30 years. Borrower paid monthly is better. One of the biggest things we try to push is, because there's still sometimes some lenders still push some higher FICO score borrowers into FHA that they don't need to. This is just one example of that. Split edge, this is the area that I'm going to show you guys an example for. This is where it can be really cool, if you're creative, and if you have a borrower that's willing to be a little creative with you, you can do some really cool things. But split edge has 3 FICO score buckets: 680 to 719, 620 to 679. But what it allows you to do is pay for a portion of the MI up front to reduce the monthly premium. So from a half a point all the way to 1.75, you can have your borrower pay that. You can pay that. The seller can pay it. A builder can pay it. But the big thing to remember is that this upfront portion will be included in your QM calculations, but the monthly one will not be. So that's something that you need to be aware of. There's certain pricing inefficiencies here that, again, I'll go over later between here and monthly, because monthlies, rate card, and for all Radian and all my other competitors too, we use risk-based pricing on monthly borrower paid MI, but Split Edge has not gone through that same model. So there is inefficiencies that you can take advantage of, and I'll show you guys those later. We'll go over that later too. I'm going to skip that. Here's a simple example really quick of a 720 FICO score compared to FHA, with the borrower doing 1 point up front for Split Edge. And it's a little bit higher than I typically like to do it, but at least in this example, they bumped up the rate so that they'd be able to pay for that 1 point up front. And no, so I'm sorry, it's still PITA. They did bump it up. To pay for that upfront amount, they got to $64 a month in savings on Split Edge. That's a pretty good example, but I have another one, a better one I'm going to show you guys. It is for sophisticated borrowers, so you have to measure it carefully when you're explaining it to them. But even on a 720 FICO score borrower, you can do really good for them. A 680 has another good example I'll show you guys, and the lower FICO score borrowers can do spectacularly well compared to FHA. So again, I'll show you guys some of those options later. We'll go into that a little bit later. Lender paid monthly. I've heard that some people do use lender paid MI monthly. That might be out there, but if you do lender paid monthly, this is the rate card you want to use to quote. Again, the higher the FICO score, the better.
You don't do lender paid monthly.
Oh, I'm sorry, not lender paid monthly. You don't do lender paid monthly. There's only some credit unions that do, but the lender paid single rate card is right here that you want to look at if you're doing lender paid singles. Again, the premium is paid after closing. It's not part of the 3%. The borrower is getting the cost of the mortgage insurance built right into P&I. So your borrower can write off this difference. If anyone on the call was doing business in the mortgage industry from like maybe 2004 to 2010, Countrywide Mortgage did almost all their mortgage insurance loans that they did, and they were the #1 lender. They did it under what's called the TAMI loan, a tax advantage mortgage insurance, and that was lender paid MI. And a lot of the industry did probably 30 to 40% of it was this as well, because you just bump up the rate a little bit. Yes, you have it permanently, but you're paying less overall, and most people are only in the home for about 5 to 7 years on average anyway, so get the advantage of being able to write off all the mortgage insurance. Some of you may have heard in the past, really maybe 7 years since the lending bust, Congress has been passing every year that mortgage insurance was tax deductible. They haven't passed that this year. Every year up until 2017 so far, it's been tax deductible for those that make under $100,000 a year, but Congress hasn't passed it. I haven't heard that they're going to pass it this year, so that may not even happen. So us being able to say that MI is tax deductible under the law under that point is probably going to be going away, because it seems like they got a lot of other things they're dealing with this year. So if that happens, lender paid MI is the only place where you can go where MI is tax deductible. So you can give your borrower a much better deal by doing that. Here's an example. That's probably the most aggressive example compared to the other two that we've seen so far in regards to cost savings. With a 740 FICO score for your borrower, the rate has been raised. If you see, it's 3/4 of a point higher than the FHA rate, but still your borrower is saving $74 a month compared to FHA on that example. So that's where it's really great. That's not even showing the tax deductibility that they get on top of that because of the higher interest rate and the MIs being thrown in there. So another good example. How are you going to market lender paid MI? The premiums paid after closing. You not have to worry about the 3%. Is your borrower focused on a low payment more than they are on note rate? This is what you want to use. It can also help you qualify more borrowers due to DTI. You may have some borrowers that just do not want to do FHA regardless because of the MI premium. They may not want to do borrower paid either because this MI is evil. You can actually sell this as a no MI loan, which is just the same as that tax advantage MI loan. If you're selling it as a no MI loan, you're just bumping up the rate and they have no MI. So this is how you do it, is using lender paid MI. Let me take a drink here, guys. All right. So hopefully those are a couple products that have helped you guys out there. The very last one, which I'm not going to focus too much time on, is the single premium. It's just not done very much anymore, guys. If you are doing it, you may have enough room under QM to make it happen. I'm just going to scroll through some of these slides. This is the important one to keep in mind, that regardless of who pays this, whether you as the lender are paying it, or the builder, or a seller, or anybody, it's still a borrower fee, so it'll be included in that 3% point and fee cap. So even though it could be really low, which sometimes they are in single premiums, especially if you have the really high FICO score and a lower loan to value, you might see 1.375 for 1.37 for a 740 FICO score or higher. But it would still eat up some of that room that you have for your fee cap. So just be careful if you do them, and that you're doing them right, and that you understand the ramifications from a QM standpoint. And again, these rates you're seeing right here are non-refundable. If you saw the refundable rates, they'd almost be about a half to a point higher, so you wouldn't even want to quote them, and that's what most people don't. And are we talking to mostly people in Texas? Yeah. Okay. Well, probably throughout the country, appreciation's been going up at a pretty rapid clip. So the other bad side about these is that since they are non-refundable, you have some people that may actually still do these every once in a while, and then a year or two later, the home's appreciated so much, which has happened here in Austin. Actually, a loan officer did one of these about a year ago, and his home appreciated so much from a 95% loan to value to get below that he was able to drop MI, but he couldn't because he paid it all up front. So that's one area why you want to be careful for recommending these, especially in an appreciation or a market that's appreciating rapidly. I'm not going to go over the example. We're just going to move on here. Some important things that you guys can do. How can you calculate the best choice for MI? We have a tool that I'm going to show you guys here real quick. I'm going to run an example through. We have a rate finder, which actually you guys can, I'm not even going to tell you about rate finder too much today because you can use Encompass to do everything that you need to do with Radian. And it puts all the MI factors throughout your whole loan where it needs to be, and you don't have to worry about it, and that's really great. One other thing I'll tell you guys about is we have a self-employed income analysis calculator that I'll show you guys where you can access that too on our website. But I'm going to try and switch it over. I think I just drag it. Just drag it over? Okay. Like this. Mm-hmm. Okay, cool. Our website is www.radian.biz. If you come here, this is where you could, if you just wanted to find an MI rate quote, which again you can do through Encompass, but if maybe you're on the road, which Radian has an iPhone app which you can download. I just look for, if you search for Radian rates on the Google Store or the Apple Store on Apple, just type in Radian rates, you can download it. Just send me a check for $5 and you're good to go. No, I'm just kidding. Just go there, it's free. And then you can pull up your rate on your iPhone. But since you're going to do it in Encompass, I want to make sure everyone saw this because this is where you can compare MI options. And this is something that's really cool because not a lot of our competitors have this tool. I don't think fact, I'm not sure who does. But there's some things you can do that you can't do on other websites. So let's say you just wanted to compare it to an FHA loan. And you can click the different products that you'd like to compare it to. So we talked about borrower paid monthlies. Let's pick that. We're going to pick split edge, and we'll even pick lender paid MI. And so we're going to fill out a couple of things. I'm going to use Texas because that's where I'm at. I'm going to put in a purchase price here of like, let's say $320. It's a primary residence, single family, 1 unit to purchase. Let's say we're going to do 5% down. No, it's FHA, right? So let's do 3%. 30-year fixed. Full doc. Put in the first mortgage rate. What's the first mortgage at now? Like 4.25%. Okay, it's for lender paid MI. Typically, I'm going to do a 720 FICO score borrower, so it might be about a quarter in rate that you'd have to bump it up to pay for that lender paid MI. And for split edge, for the example I'm going to show you, we're at least have to bump it up 1/8. And for split edge, I'm going to pick the 0.5 point option. That's the cheapest. And for FHA, it's a 1.75 up front, 0.85 for the MI. I think the rate would probably be about a quarter difference. And then the loan to value, 96.75 for 3 and that's right, 3.5. Yeah, down payment. Okay. Oh no, yeah. Sorry, not 7.5. Okay, what does that's typically what you'd put in, maybe with a little bit more detail than you would just to get a normal rate with us. But we're asking for a couple other things like these note rate information. And then this asks for a couple other things like how many years do they expect to be in the home? We can go from 1 year, 2 year, 3 year, all the way up to 10, up to the life of the loan. So you can do a lot of things with the amortization here. So the average is about between 5 and 7, so I'm just going to use 6. For FICO score, we're going to say a 720 FICO score borrower. There's no non-traditional credit. And what this also does is it assumes some things on an interest rate scenario. So what's happening to interest rates? So we're just going to say stable, because really rates haven't been doing too much. And it also throws in house appreciation per year. So depending on what your market is, you can put in 0 all the way up to 20%. Austin's been having really good appreciation lately, so I'm going to say 6% per year. At least it might be that way for at least the next couple of years. We're not building enough houses fast enough out here. And then for these, just use automated underwriting system, use Fannie Mae Desktop Underwriter, approved eligible. You never have to really even touch these 3 unless you're doing Freddie Mac. You may want to put that in there. It says Radian Standard. You're going to keep it at Radian Standard, but for this one, we're going to assume that we're doing Home Possible. So you change this to 25% coverage. So we're going to click Submit, and just let it think for a minute up here. I think gives us all 4 options here. So all the different things here, we see the interest rates for the various products are across the top. We've got a 96.5 versus 97s. Here's the upfront premium for FHA. Shows you the loan amount. Here's the MI premiums here. The monthly payments for MI. Here's the total P&I, or just P&I payments. And here's your total monthly payments across the board. So borrower paid is $32 more expensive than the FHA payment. The lender paid MI is $122 cheaper than the FHA payment. Split edge with just a 0.5 point up front and then about a quarter higher in rate is still $43 a month cheaper than FHA for just a 0.5 point. The point at which MI can be canceled, because of what it's doing is we told it 6% appreciation. At 33-month point is when it gets to 78% loan to value. So that's when they could contact the servicer of the loan and get the mortgage insurance canceled. So that's really cool to know that, and you could be able to use this calculator to show that to your borrower and when they could expect to get their MI canceled. If you wanted to be really aggressive and use this as a marketing tool, you could actually put this, put a date in your Outlook calendar or whatever contact system you guys have that to set as a trigger point to remind your borrower maybe a month or 2 before for them to contact their servicer and get that ball rolling. Maybe they got to order an appraisal to make that happen. But once they do that, once we kind of show that here, that P&I payment at year 6 is still shows the MI being dropped. So Actually, they get a little bit, yeah, because since MI's dropped, it's now the payment's $1,504. Here it's 15. Well, this is $1,573 because it's lender paid MI. But here it goes to here instead of this $1,726 payment. So it calculates that all for you. It also shows the total amount of interest paid over 6 years, and shows you the total amount of mortgage insurance paid in 6 years. Look at this. This is for FHA, $20,000 in MI they pay over 6 years, versus only $6,500 on a borrower paid monthly, which was still more expensive, $32 monthly, but they're paying $14,000 more for the honor of dealing with FHA. And then here, this is a little bit, there's another payment here, and there's a little bit of MI here. But the principal reduction is a little bit more. The reason why it's a little bit more is just because they're paying a higher payment overall, and stuff starts sliding into there. But the cost of financing the house over 6 years is almost $90,000 for FHA. It's $81,000 under borrower paid monthly. Lender paid is $79,000. Split Edge was the cheapest here at $78,700. Here's the rate of loss or savings here. So you see, all of them are better than FHA in that example. But this is where it gets cool, and I'm going to show you guys real quick. We're going to change it from FHA. Just going to do a borrower paid monthly versus Split Edge. The same example. And we're going to go to a 640 FICO score. Now, Split Edge is where it gets really cool, is right here. Because a typical borrower paid monthly in the lower FICO score buckets, most people think that when they're comparing to FHA, they go, man, the MI rate was 1.67. And on FHA, usually it scares them away because of that, and so they go back to FHA. But if you were to do Split Edge and just bump up the rate an eighth, so wait a minute, I need to go bump this up a little more. If 4.25 was your start rate for your normal conventional on a borrower paid monthly, then we have Split. Your payment, your borrower is saving $135 a month, even though you increase the rate an eighth to pay for that half a point. So they can save $135 a month over this 3-year time frame. Actually, when you crunch all the numbers, they saved $1,600 using that example of Split Edge, and also they saved $135 a month. So if you're trying to be the most competitive compared to someone else that quoted them on a borrower paid monthly, Split Edge would be the way you want to go. And that's what I recommend to a lot of people. Even on higher FICO score borrowers like 720 and 680, Split Edge can be a great way to do this. And that's what I'm talking about, where you can save thousands. This, at least in 1 year, you take $135 times 12, you're saving your borrower quite a bit of money over that first couple of years. So that's where they can really come out ahead. I kind of showed you guys the decision calculator. I'm going to tell you real quick about how to cancel MI. Like I said before, this is my most often asked question. MI can be canceled automatically when it gets to 78% of the original property value, which FHA, especially over 90, can never be canceled. So MI can be canceled at the borrower's request if the mortgage balance is 80% of the original value, payments are current, no other liens exist, the investor is satisfied. So it's never the MI company's decision on when to cancel the loan. That's usually get asked a lot, is to when do we cancel it. The servicer is technically our client at that point. So whenever they want it canceled, we'll cancel it. But the law, there's actually HOPA, the Homeowners Protection Act, kicks in when it gets to 78%. But typically, that's not going to kick in until about years 9, 10, or 11 of a loan completely amortizing. So that's usually not what people want to wait for. But if they're trying to get it canceled earlier than that, like in those examples that I showed you guys at like the 33rd month, they'd made enough payments and the home had appreciated at least a 6% rate, they think they could drop their mortgage insurance. So what the servicer would have them do is pay for an appraisal, about $500. They get that done, send it into the servicer. Usually it takes about 30 to 60 days, but they'll compare that to their current mortgage balance, and if it's less than 80%, then they'll generally drop the mortgage insurance for them. Usually Fannie and Freddie request for them to do just 2 years, at least if you're going that route, before they'll drop the mortgage insurance. Yeah, and that kind of goes over that again a little bit. The other way to do it is if they did structural improvements, like let's say, so they bought the house, they sold their other house, they had a lot of money. Instead of putting it down, which they could do on their current mortgage balance, they decided to put in a pool and a new roof and did a bunch of stuff that they think significantly increased the value. Then they'd still have to pay to get another appraisal on top of that. But then once they send that in with all the stuff being done, they could go back to their servicer and get that canceled. Some servicers don't always require an appraisal. Sometimes they use a broker price opinion or a CMA. But I've seen broker price opinions being used. Wells Fargo will do that, especially if they've owned the home for maybe 4 to 5 years plus. They'll do that instead of an actual appraisal. If you need any help with training, I know Leslie does a lot of good stuff for you, but we're always there to help you guys as well. We do a lot of videos on demand. Radian can do in-person workshops. At least if we try to have at least 20 people there, we can do an in-person workshop. And we have a lot of good information on our website that you can get these things from. Live webinars as well. So a couple things, just to go over one last time with you guys. How to empower yourself. Borrowers want more options. I've given you at least 4 good MI options on how to help yourself be more marketable out there. We're trying to help you be the high loan-to-value expert. Remember, it's a huge market that 83% of millennials don't think that they have to put more than 10% down. So you want to be that expert. These are creative, and I told you about some underutilized MI products, like Split Edge. Split Edge is very unutilized, and it saves, just pure as the math right there, it saves your borrowers real money. Conforming can be better in regards that it's easier and it's cancelable. Your borrowers can get out of it. They're never going to get out FHA. And you saw the real hard cost for at least one example. Feel free to use that calculator to run other examples to see for maybe some of the borrowers you're working on right now what the difference is for them in FHA. What's the real life cost for them over 5 years, over 6 years? I just showed you 6 years. That one example, the borrower is going to be paying over $14,000 more than a conforming. They can just help you be more creative and structure different pricing options. By asking all these questions and going through that, I know even though sometimes your borrowers may not be patient enough to do that, but if they're a little bit sophisticated and if you can sell them on the reason why they need to walk through with you on these different options, you're going to get to know them better, they're going to know you better, and you're going to be able to really show what your value is over the Quickens, over the other, Rocket Mortgage's Quicken, but guaranteed rate. Some of these other ones where the guys are just sitting in their cubicle and they never get out anywhere or meet anyone or talk to realtors, you can give them real hardcore examples and help show them how you can save money. And like I said, the more quality products you have to offer, the more you know, the more likely you'll be able to close the loan. So that's the value in doing business with you. That's the value of doing business with Radian. Hopefully I gave you guys a lot of tools there that you guys can use, and I'm always available to call. Leslie can hook you up with my contact information if you need it, but that's how we try and stand out, is by helping you to stand out in these areas to give you something cool. And like Mortgage Assure, I didn't even talk about Mortgage Assure. Mortgage Assure real quick, if you guys don't know, I'm sure you probably already heard about that 1% down program and all the 3% down programs. We are your exclusive provider for mortgage insurance. The reason why we are is because that Mortgage Assure product is awesome. It's awesome because it's free. And who doesn't like free? And the only thing that your borrowers have to do is within 30 days, they'll get a letter from Radian telling them that they're with the Mortgage Assure product, telling them their servicing number, because after about 30 days, we get the servicing number from you, and then we let your borrower know what that servicing number is. So when they go to the website, which is mortgageassure.com, they get their they can type in that number, and that way that product, the free product, gets associated with them through the life of their loan. So if for whatever reason they were to be late on their mortgage and they call the servicer, whoever it happens to be, and say, hey, we're late on our mortgage because we lost our job, and then they call us, and then once we would pull that up on our system and go, hey, since they lost their job and that's why they're not making their mortgage payment, they can file a claim for Mortgage Assure and get their mortgage payment paid for. It's PITI up to $1,500 a month, up to $9,000 over a 6-month time frame. So that provides real help to them, real help to you, because the first 2 years are the most important in the servicing of your loan, and that's what your investors care about when you sell loans to them, is how that loan does during that 2-year time frame. So That's hopefully a good value for your borrower. It's not a lottery ticket that anyone wants to win, but we're there to help them out in case it does happen. So thank you, guys. Oh, any questions? I'm going to see any questions. No? Good. Thank you, guys. Appreciate it.